few moments ago.
We still remain optimistic that within this year, conditions in the United States would allow the Fed to start cutting. For how fast, I don't think that we should gear up for rapid decline in interest rates.
Can I jump in and ask? Okay, let's talk about a couple of the stocks that we're watching here today at the open. First up is Micron. The chip maker is set to get $6.1 billion in grants from the Commerce Department next week. That's according to our Bloomberg reporting. Ed Ludlow has the detail. Ed.
Yeah, let's see how Micron opens, but it's a big number. You're right that $6.1 billion is in grants, and that's important. According to our sources, that figure could be announced as soon as next week. There is a loan component to this as well, where sources say that Micron will accept loans on favorable terms as part of the funds made available by the CHIPS Act, just as Intel and TSMC did. But we don't know what the dollar value of those is, so the total package could be much larger than the $6.1 billion. Micron's got plans, both in Boise, Idaho, its kind of home state and city, and New York State. And what's interesting is that it has 4 locations and projects planned in New York. But regulatory filings recently told us that 2 of them will not be operational until 2041. That's important because Gina Raimondo and the Commerce Department have said that the allocation of funds will be prioritized relative to those projects that can be finished sooner, basically, by the end of this decade. And that would indicate that at least 2 of those New York projects will be on that timeline. And so the entirety of the funds awarded in this tranche will be related to that project. Stock, I've lost track of time, Manus. As you know, I'm a bit of a night owl anyway. We're down 0.9%. Whether the market's open or not, I believe it has now. Thank you. It's an important one. Micron, a big maker of memory chips, a market that is dominated by first Samsung and then SK Hynix, the Korean names. But as you know, if you look at the table in the Bloomberg News story of where funds have already been allocated, those same Asian chip makers are also coming for the US manufacturing footprint that the domestic players want as well. So it's interesting. The stock had been significantly higher in pre-market when we broke this news. We're now down almost a percentage point this Thursday at the market open.
Okay, thank you very much. The latest update there on Micron. Let's turn to casinos now. Las Vegas Sands reporting results. It's Macau locations that missed on the estimates. Abby has the detail. Abby.
Well, investors really not liking this, Manus. We have the stock down more than 6%, heading to its worst day in about a year, and you're exactly right. It's not the overall operations, because on the surface level, they really put up a nice beat. They put up 75 cents in adjusted profits. That's 25% better than what the street had been expecting relative to revenues, $2.9 essentially. That is a small beat, but when it comes to Macau, and that is more than 60% of their operations, they really missed the estimates. But it's not just the quarter that was. Looking ahead, some analysts are saying that they have to invest for renovations, so that could weigh on profit, and then just uncertainty in China. What also makes all of this worth noting, Manus, is so many stocks and the stock market itself up over the last year. That is not the case for Las Vegas Sands. So the uncertainty around China has been weighing for a while. Coming into today, down more than 15%. So with this stock down 7%, again, the worst day since May of last year, we now have the shares of Las Vegas over the last year in a bear market.
Abby, thank you very much. Let's turn our attention to airlines. Alaska Air expects second quarter profits to top analyst estimates, signaling that the carrier is recovering from its Boeing crisis. Katie Greifeld has the detail. Katie.
Yeah, we know that the first quarter was a little bit rough for Alaska Air. Of course, we remember that January incident, and then you had federal aviation regulators grounding all 737 MAX 9 aircraft after that incident until the inspections could be completed. Alaska Air did earlier confirm that some travelers had opted to fly on other airlines for a period after that incident. But looking ahead for the current period, they actually raised their forecast for adjusted earnings, saying they will be between $2.20 to $2.40 a share for this quarter, really backed by that surge in travel by tech companies in particular. Analysts had been looking for $2.12, so a big beat there. And then you take a look at their forecast for the full year ahead, and that actually beat expectations as well, or rather they raised it. So EPS for 2024 expected to be between $3.25 to $5.25. The previous range had had been $3 and $5. So a raise there. Definitely what shareholders wanted to see. You see shares currently up higher by about 1%, had been as high as 4% higher a little bit earlier, but definitely an up day so far for Alaska Air.
Katie, thank you very much. Stock reacting nicely there. Turn our attention to the home builders. D.R. Horton increased sales expectations for its full fiscal year. This is the housing market heads into its key spring selling season. Simone, how does the season look?
Well, on the earnings call just now, executives have been talking about this, and they said they've actually seen the market stabilize and seeing, quote, a very good sales pace in line with our overall plans, even despite the higher rates that we have seen into April. But as you mentioned, Manus, the company able to raise its sales projections for the full year, which ends at September 30th, now seeing building 89 to 91,000 homes and selling them. That was 87 to 90,000 homes. Second quarter results pretty positive here, coming in ahead of analyst expectations with home orders up 14% year on year. Pre-tax margin also higher than expected, and that allowing the company to deliver a beat on its earnings at $3.52. The expectation had been $3.07. Now, again, we're paying attention to the call here. Citi said cancellations were well below expectations, but it wants to know how that plays forward, wants to know more about buyer demand and traffic in April. Jefferies calling this a robust beat, but on the call, it's really going to be focusing on those margins, given the incentives, the buy downs that D.R. Horton has been offering. Shares, though, were higher now, but now up about 2.5%. They had been up their most since December. We'll see where the day closes, Manus.
Okay, Simone, thank you very much. Let's continue the conversation about risk this morning. JP Morgan's Kelsey Barrow and Moneta's Ethan Devitt join me. In terms of the narrative that we're just hearing from the IMF, in terms of the message from the bond market, which my last guest said of CalSTRS is perhaps the most important bell ringing in our ears. We're in a higher for longer narrative. With that in mind, Ethan, let's start with you. This higher for longer stockflation narrative, how do you interpret that?
Well, first, it's a new narrative. We were speaking about Table Mountain and how long it was going to last, but we certainly thought that that table was coming to an end soon, and we were looking at those cuts. So now it seems somewhat exhausting that we've done this round trip in terms of Treasury yields, and we're right back to where we started a few months ago. That, of course, does have implications for stocks. It has implications for the bond market. The 60-40 portfolio won't look too good if the total return of bonds are falling, and it just puts everything in question again. It's like, are we right back to where we are before? What does this mean? How long can these higher rates be supported, be sustained by consumers and corporates? So it does, unfortunately, add to that wall of worry.
Kelsey, how are you feeling about it? Are you exhausted? Are you exhausted? We're sort of back to where we started, as Ethan just said. Do you sense a level of exhaustion here? We haven't quite broken the 475 yet in bonds. Take me through your view on stockflation.
So in terms of exhaustion, we have seen a significant repricing in yields. I look at the one-year rate, and it's over 100 basis points higher. So the market has already efficiently responded to the stronger growth and stronger inflation data. But I think the differentiation between now and, let's just say, October of 2023, where a lot of people are drawing those parallels, is back then, the Fed wasn't done hiking yet. It was still not clear if they would need to go further, and the market was pricing in additional hikes for 2024. Today, we're in a different environment, an environment where there are limits to how far yields can sell off, because ultimately the Fed is deciding between two outcomes, not three. There used to be three choices: hike, stay on hold, or cut. Now there's two choices, which is stay on hold or cut. So these higher yields, what we're hearing from our clients is actually are a great opportunity to get invested at these higher yields and start building a portfolio that has diversification and has income again.
Well, tell me, Ethan, then, I mean, you said the 60-40 portfolio, of course, will have taken a hit just by the virtue of the fact that bonds have underperformed so much. But what is it that would make you take investment grade or sovereign yield? Do you think there is one more leg higher in yield to come in these bond markets? Or do you incrementally add and say, okay, 60-40 will begin to return to normal performance in the back end of the year? You've got geopolitics at play, and you have some people saying you will still get 2 insurance cuts. Some people are saying 6.5% rates. But the thesis, the consensus of the market is at least 2 insurance cuts.
Exactly.
Well,
right now, because we... Oh, sorry.
Ethan.
because we know that inflation is coming down. We know that that makes that real rate of return all that more meaningful. We know how much investors rely on income. They haven't been getting income from the equity market. The concentration in the equity market has made it look a little unsettled. And there is quite a bit of, I think, fear around there. We're seeing volatility pick up and a lot of noise circulate. So I do think fixed income makes sense today. Just like your previous guest, Christopher Ailman, mentioned, it's not just public fixed income. It's private fixed income. It's right along the spectrum. It's playing that exit of banks from the lending segment. Banks are actually doing quite well. We've seen that in the equity side. It's good that finally another segment is starting to come to the fore. So I do think the case for fixed income is there. Technically, because spreads are so tight, I'm not seeing a ton of enthusiasm around pricing where they are today, especially in high yield or investment grade. But I do think that as having a role in the portfolio with these levels of yields and inflation coming down, it does make sense.
Kelsey, I'm heartened by the fact that you say there are limits to how much further this sell-off can run.
So we think there are limits to how much further yields can rise because the Fed is still in a mode where they think they've done enough, and the next move is either to stay at these levels or to move lower. So what is causing that conviction for us is ultimately we do think that inflation should be moderating. We need to see it in the data. The Q1 data was a little bit of what we hope to expect to be an outlier, but we do expect inflation to be moderating and growth to be moderating. When you look at Q3, we were running at 5%, and then Q4, we were running at 4%. Now Q1, we're running at 3%. These are great growth numbers. They're a great backdrop for corporate fundamentals, but it is still an environment that's moderating. Ultimately, the Fed is in a good place here.
Do you think, Kelsey, it's wages that moderate more quickly than we presume, or is it that growth slows down more materially? I was listening to the global head of economics for UBS on surveillance just at the end of the show. He said the sources of growth in the United States of America are narrow. They were fiscally driven in 2023 through the IRA and through the CHIPS Act, and that those fiscal boosters will dissipate. So this slowdown, the confidence that you have, what is that most predicated on?
Yeah, so our confidence is not about growth rolling over or being very negative. It's really just the fact that it's healthy, but it's not necessarily reaccelerating to the point where the Fed needs to re-engage the hiking cycle. So that's really the differentiation. But I will say on the wage front, that's probably the area where we've had the most consistent amount of information that is pointing in the right direction. I turn even to the Beige Book released yesterday. There was a comment in there about, in general, wage gains have basically returned to their historical averages. So we had a period where there was a very intense labor shortage and the employee had the upper hand. That's really just returning to normal. It's not indicating that the labor market is weak, but it's indicating that the labor market is more balanced.
Even if we can close off with a comment from you. I know that you've been looking at the dollar. It's the only thing that anybody's talking about in Washington. It's amazing how the conversation shifts from our markets here in New York to the IMF meetings in Washington, and it is about the dollar strength. And you now have a trifecta of admission that that strength in the dollar is something the US is prepared to allow the Japanese and the South Koreans perhaps to reduce. Your interpretation of the strength in the dollar and Yellen signing on to this press release, which we would say tacitly allows the others to intervene.
It's very interesting right now. We have on the one hand, and again mentioned earlier, the rise of gold and Bitcoin, suggesting a concern around currency debasement and some concern around those rising levels of debt at a country level. And then we also have the US dollar being so strong, the juggernaut of global growth and the penalty that that represents for other countries essentially, and how we now end up with the US continuing to be in the lead. So it is a problem, this strong dollar. We have to remember we're dependent on a global economy. It cannot be sustained forever, and we think that is going to ultimately show the ongoing weakness of our trade partners. So it is interesting. I probably should not be sustained, but then again, that's the anomaly, that we see this concentration in markets continuing to exist and really distort the picture.
Well, I'll leave you with this thought. It was 2019, and that's when the US accused China of being a currency manipulator. Japan and South Korea were on the same list as well. How things have changed. Ethan, thank you very much. Ethan Devitt, Kelsey Barrow on markets this morning. It's all eyes down for Netflix. They're going to kick off another round of big tech earnings.
I think there's certainly room for upside. Netflix has positioned themselves to get a little bit more focus, shifting from the subscriber growth to revenue overall, given their ad-supported tier strategy.
Let's hope you're not sharing your password. Netflix down just over 1%. We'll dig into what the reports are expected to give us. Indeed.
think there's certainly room for upside. Netflix has positioned themselves to get a little bit more focus, shifting from the subscriber growth to revenue overall, given their ad-supported tier strategy. Our survey work during the quarter continues to show the absolute stickiness of that premium tier.
Netflix will kick off the big tech earnings after the closing bell today. Analysts are expecting streaming leader to register another strong quarter of growth in subscribers following a crackdown on account sharing. Geeta Raghunathan is from Bloomberg Intelligence. So all eyes down on the subscriber growth. Where will the alpha of growth come from geographically, Geeta?
Yeah, Manus, it's always kind of been more on the international side. So the U.S. is a pretty mature market right now. That said, their new initiatives, both with the ad tier as well as the paid sharing, where they're cracking down on password sharing, has definitely helped kind of reinvigorate U.S. growth. But majority of the growth there going to come from the international markets. Asia Pac and Europe are the big ones there.
And to sustain that, I mean, they've got multiple growth drivers. I'm just curious, how does pricing going to play into this? I mean, I look at my own TV. I think I've got Amazon Prime, I've got Apple TV, I've got my Netflix. I'm a multi-channel. But even I'm nearing the limit of what I want on the television in front of me. I'm not that price sensitive, but tell me about the rest of the market.
Yes, I think what Netflix has managed to do is in many ways, Manus, they have really won the streaming wars, and they have kind of become this de facto option right now for most households across the world. I mean, if you're thinking of entertainment or what do I watch today, I mean, you kind of tend to gravitate towards Netflix, and that's what they can really bank on when it comes to pricing power. So they definitely have the edge relative to their rivals. And if you just kind of think about, you know, the U.S. itself, their standard plan, which costs about $15.50 a month, the last time they raised prices on that was back more than 2 years ago, January of 2022. So obviously we're due for a raise there. And I think what really kind of gives investor comfort in terms of are they able to raise prices? I think yes, it's a resounding yes, because now they have this lower priced advertising option. So anybody who's very price sensitive, obviously they can control churn because you do have that lower priced option now for, you know, $7 a month in the US.
Okay, Geeta, thank you very much. Let's see what the numbers say tonight. And who out there doesn't press yes when it just comes up? The price has risen. Do you want to continue with your subscription? The bond market matters. Listen to it more. That was the message from CalSTRS, who were with me just a little bit earlier. Now, yields are popping ever so slightly higher. The U.S. jobless claims come in at 212,000. The estimate was for 215. So a solid jobs market. Another reason for the Fed to obfuscate, to extend and pretend. But I'm drawn to Williams' comments from the Federal Reserve, where he says rate hike is not the baseline, but possible if the data warrants it. So again, they're trying to reaffirm that rate hikes are not our baseline. But he does go on to give you the counterbalance. So the bid and the offer, which is they will cut rates at some point. The economy will drive the timing. So there's a number of facets in this bond market this morning. Monetary policy is working the way we hoped. Those are the lines coming from Williams. Let's get into the sector price action. Abigail Doolittle is with me side by side.
So it's another interesting day early on, Manus, because we have already had stocks start higher and then go lower. Right now, up ever so slightly, a pretty even split. Actually, we've had a number of sectors just over the last couple of moments go ever so slightly higher. The best sector on the day, though, communication services up about 0.6%. Financials, industrials also higher to the downside. Tech and discretionary utilities. No big moves, though, right now. Investors are trying to figure out what's what. Where we do know what are the chips. We have the stocks down 1.2% over the last 4 days or this week. I believe that's what we're going to see here, down nearly 5% on the month, heading to more than 8% decline, the worst in many, many months. And of course, there's fears for NVIDIA too far, too fast. I'd also point out yesterday the possibility of tariffs by the U.S. Against China on aluminum and steel. Well, of course, the poster boy for tensions between the U.S. and China, that's chips. So I think that there's some tension hitting the chip sector on that possibility as well, Manus.
Yeah, well, NVIDIA down 4% on the week. It's got a small bounce in it this morning, Abigail. You're right. Those chips are a real focus for us at the moment. Coming up in the show, we'll give you the market moving events to set your clock by right here on Bloomberg. Markets are struggling for a really clear direction at the moment, as you can see. Nvidia's up by 0.5%. S&P barely holding on to its 5,000 level. Let's see how that plays out through the rest of the day. We're going to get those Netflix numbers later in the day. That can help define perhaps where some of the big tech sentiment goes. Now, in terms of the rest of the agenda, it's a matter of moments before we get the existing home sales for the month of March. As I said, Netflix will come in after the bell. And then tomorrow, India's general elections begin, and we get the earnings from American Express. That was Countdown to the Open. We've been off to the IMF meetings in Washington. A very clear message from the managing director there, which is about China. Rebalance China. Boost your domestic spending. And in terms of the angst over the strong dollar, well, let's just see what happens next. But that is as much a political statement from Janet Yellen as it is about a financial statement in terms of the strength of the dollar and what the Japanese and the South Koreans can do. We're struggling for clear direction in equities. We'll get a little bit more clarity as the day rolls on, right here on Bloomberg. Good morning.
We are 30 minutes into the U.S. trading day on this Thursday, April 18th. Here are the top stories we're following. All about margins this earnings season, says Sophie Lund-Yates of Hargreaves Lansdown. We'll chat with her about the outlook for big tech to luxury as stocks continue to wobble. And to focus on chips, TSMC shares under pressure after results showed ongoing weakness in smartphones and PCs. Meanwhile, Micron is set to get over $6 billion in grants from the CHIPS Act next week. And a conversation with Marsh McLennan following the insurance broker's beat on earnings this morning. CEO John Doyle joins in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets at this moment, and it's an interesting but a quiet day in markets. You can see the S&P 500 slightly higher, and I really emphasize slightly. They're up about just 0.1% on the big index. Looks pretty grim if you take a look at big tech. Of course, the NASDAQ 100 currently off to the tune of about 0.2%. Meanwhile, you take a look at small caps. The relative outperformer today, the Russell 2000, currently up about 0.2%. We'll see how long that dynamic can hold. But let's talk about Taiwan Semiconductors, the chip maker delivering a better than expected revenue outlook on AI demand. TSMC expecting revenue to grow as much as 30% this quarter. Bloomberg's Ed Ludlow joins us now with the details. So a blowout there, but then you take a look at what's going on in smartphones and PCs, and maybe that tempers the outlook a little bit.
And that's probably reflected in TSMC's US-listed shares, or the ADRs. They're down more than 5%. So there was a lot of notable milestones that make us think the world's biggest contract chip manufacturer. And just to explain that very basically, TSMC actually manufactures the semiconductors for the companies that design them. 50% revenue growth annually for their AI products. You're right about the top line growth overall. It was also the first profit growth they've had in more than a year. And the market really seizes on that CapEx number. When TSMC says we're going to commit to this CapEx spend, it gives you confidence that they see markets that are growing. The downside is that there is still weakness, and you pointed out the smartphone. That is a pocket where we're still seeing slow growth, even if AI is fantastical.
Yeah, that's what's interesting here. I mean, when it comes to one of the biggest narratives out there, AI, of course, TSMC saying that they're expecting to see a growth tailwind from that, but it's really the smartphones and the PCs managing to overshadow the hype around AI.
Yeah, you can size and scope it. You know, NVIDIA is the market leader for high power GPUs or AI accelerators, and TSMC is the contract manufacturer that makes them using the latest and cutting edge chip manufacturing technology. But Apple is also a really big chunk of TSMC's revenue. Depending on any given quarter, it can be 20 to 25% because of the footprint of the iPhone and the high-end processors that the iPhone has. But that is where the weakness is right now. And so, you know, there is a holistic view of semiconductor markets that you have to take. And actually, those were the more worrying pieces of commentary that TSMC said overall, where growth in terms of end markets or the people we sell to won't be as good as we thought.
All right, Ed Ludlow, really appreciate the context as always. Of course, you can catch Ed in just about an hour, but stick with us now because we're going to talk about the markets, and we're going to do that with Sophie Lund-Yates. She is Hargreaves Lansdown lead equity analyst. And Sophie, delighted to have you with me. I'm taking a look at your notes, and of course, this line catches my eye, that this earnings season is all about margins. If that's the focus, how are you expecting that to actually fare?
Hi, great to see you again. So yes, fundamentally what we know is that there is a huge correlation between the S&P and what margins do. So what margins do is going to map how that index performs. Now for me, I think as much as there is a great deal to be excited about as we head into this earnings season, I don't think that the margin pressures, for me personally, not everyone agrees with me, but I just think that margins are going to be under a lot more pressure than is currently being priced in. You know, you've just been alluding to it there with your previous guest. The amount of money that needs to be spent in order to get AI propositions really off the ground and into something tangible that investors can get excited about for a lot of big names simply is not being priced in. You know, these big tech names still have absolutely a lot of reliance on more traditional revenue flows. It's not all about AI yet, and getting it there is going to cost a lot of money. At the same time, we have a lot of consumer weakness. So you put all that together, and I think that margin accretion is going to be really quite hard to come by.
Sophie, I'm really glad you say that because I've been saying for a while that this AI story, it sounds like really a story of margin compression for a lot of names up until it actually starts to benefit the bottom line. So I'm feeling a little bit vindicated, but we've talked about it in relation to tech, AI. What about the rest of the market, though? When you think about margins, the focus on margins when it comes to some of the other sectors and industries in the benchmark, what might that look like?
Yeah, sure. So, I mean, this is quite a broad spectrum that, we can look at this. I think, as you say, on one side, tech absolutely, I think, we have some names that could be in a little bit of trouble there. I think there could be some nasty surprises. But actually, when we zoom all the way out and start looking at other sectors like retail, like consumer discretionary names, I think that there is a lot of pain to come there. We've been talking about the fact that inflation is stickier than anybody was hoping for, particularly core. That's a real problem. And actually, we've seen that consumers have actually stopped spending on everything that they possibly can from a discretionary standpoint. And that means that actually what's left is some really quite drastic decision making. And I think when we look at mid-market fashion, for example, I think that there is a great deal of challenge to traverse. And I don't say that lightly, but I don't think we're through the worst of it yet.
So it sounds like we truly have reached the limits of pricing power then.
Yes, I absolutely believe that. We see that in, for example, say luxury is actually performing relatively well. I continue to be pretty bullish on LVMH, even though their growth has slowed. People are still ultimately buying their clothes at these crazy price points. But actually the middle market, so your average consumer, absolutely price sensitivity is really something that is causing a lot of headaches. And I think that this could actually get worse before it gets better. And that, of course, actually feeds into this tech story when we start looking at whether businesses are going to be spending big on technological revolutions and investing in cloud for their own businesses and things like that. They all feed into each other. And I do actually think that we're going to see more of a pullback than is currently being expected.
Okay, so maybe some pain coming in the middle market. Luxury, you're still feeling pretty bullish there. Let's talk about the other end of the barbell, of course, maybe some of those discount retailers. What's the mood music there?
Sure. So this is a really, really difficult one because within discounters, we have some absolute best in class, right? And they are successfully pumping up volumes to make up for the fact that they are managing to keep their prices on the floor. But with that said, it's a really crowded area of the market. And because of that, I do actually think that we could be seeing some consolidation coming through. Now, because as much as, people might be listening to me thinking, well, the US retail numbers were much better than expected very recently. They were better than expected, but they were still very sluggish. This is not growth to be excited about. That tells me that consumers are still incredibly discerning. And actually, the discount area of the market is a scarier place to be, largely because your margins cannot stomach any level of disruption. So I do actually think some consolidation between names is possible over the next 12 to 18 months.
It's a good point, too, on margins. Razor thin when you think about some of those retailers on the other end of the spectrum there. But it's interesting. You add it all together. I'm looking at your notes. You're not necessarily looking to overweight defensives here. The cyclicals actually in this environment still look pretty good.
Yes, absolutely. So in the short term, the cyclicals are actually meant to perform better. We'd expect them to be a bit more resilient, particularly in the short term. That bodes well for the US market as a whole. So I don't think that that's something that should be ignored. Certainly not, because actually when times are tough is potentially the time to be considering cyclicals as that wheel starts to turn, right? You don't want to do it further down the road. But at the same time, I don't think now is particularly the time to be completely ignoring those defensive options either. This is a debate on my team often, but I'm very much in the camp that I think the bedrock of portfolios should include defensive names at the moment. So that's including those with those really wide economic moats. So not the most exciting names, but that's everything from defense to telecoms. Not the most exciting, but certainly I think worth attention. But certainly with a nod to cyclicals at the moment, absolutely.
Well, Sophie, don't undersell it. We're going to get into some single names next. Just to hang tight for just a couple minutes, and let's take a look at what's moving underneath these markets. We're going to do that now with Bloomberg's Emily Grafeo and Morgan Stanley with some tough words for eBay.
Yeah, well, a double upgrade actually for Morgan Stanley. Yes, they did have tough words. Just yesterday, their analyst Nathan Feather was actually the most bearish analyst. He had a price target of 35. That was the lowest on the street. And now he's upped that price target to the most bullish on Wall Street, and an overweight rating. Price target now implying a jump of about 25% for eBay. And it's all about eBay's embrace of generative AI.
I've heard that before.
Morgan Stanley is now saying that they're positive that's going to deliver growth. But I actually looked at some of these AI tools that eBay has recently rolled out. One of them is a tool where a seller can just take a photo of a listing, and the AI will actually fill in the description of the actual listing. So all they have to do is snap the photo, and then they can continue on with their listing. And then another tool where shoppers can actually look at items and get more tailored recommendations that the AI recommends. If you like this, maybe you'll like that.
Yeah, if you trust the robot. It's interesting. It's only worth about a 2% rally in eBay shares right now, but we'll see, of course, how that story plays out. Talk to me about Las Vegas Sands.
So that was declining as much as 9%, biggest drop since October 2022. And actually, when you look at the top line earnings, it wasn't that bad. They actually exceeded adjusted profit expectations, but a lot of the revenue that Las Vegas Sands gets is from its Macau regions, despite the name Las Vegas Sands. You look at some of the properties, the Venetian Macau adjusted property EBITDA was missed estimates coming in at $314 million versus estimates of $322. They also said on the call that the Macau results are going to be further impacted by renovations in 2024. And so we're seeing a number of downgrades. Jefferies, their price target, this is a less bold call when you compare Jefferies to Morgan Stanley. Reduce the price target to $53 from $54.
Okay, all right, it's some movement.
But they also said that those renovations are going to weigh on profitability for Las Vegas Sands.
Well, you look at shares right now currently having their worst day since October 2022. Let's end with a good story, and that's what's going on with home builders right now.
Yes, D.R. Horton, that stock up about almost 3%, pairing some earlier gains, but still in positive territory. Their earnings were pretty solid. Second quarter sales and revenue rose above estimates, and then they also